Today's podcast is brought to you by Horizon's Resolve Adaptive Asset Allocation ETF, which trades on the Toronto Stock Exchange under the ticker symbol HRAA and is sub-advised by Resolve Asset Management. HRAA is an alternative fund whose investment objective is to seek long-term capital appreciation by investing, directly or indirectly, in major global asset classes, including, but not limited to, equity indices, fixed income indices, interest rates, commodities, and currencies. HRAA gains exposure to these asset classes by investing in derivative instruments that may include future contracts and forward agreements and securities. HRAA will take long or short positions, using up to a maximum of 3 times leverage in asset classes such as equity indices and fixed income asset classes, commodities, currencies, volatility indices, and other alternative asset classes. To learn more about this, please visit www.horizonsetfs.com/HRAA to read about the ETF's investment objectives and important disclaimers about the risks associated with an investment in the ETF.
And we're live.
Hey, boys.
Oh, there's a bit of a delay in Rod's audio.
That island internet, as you tripping it up.
Hey.
Internet's island internet as well, and he seems to be doing fine. So.
Yeah. True. Well, gentlemen,
I think my CPU is at 100%. This is the problem. All right.
We'll figure it out. Cheers, gentlemen.
Cheers.
Patrick, thank you for joining us for Resolve Riffs and it being 24 hours earlier than usual. Appreciate the ability to come on, and I hear you're also on a Caribbean island.
That's right.
Fantastic. I will say that anyone listening to this should realize that if there is no investment advice here, there's only fun and opinions and some thoughts, and that you should get help. You should probably go subscribe to Patrick's service and get some help with your trading if you're doing that, etc. All of those things. We're going to have a wide-ranging, unbridled conversation, and we want the ability to do so. So no financial advice here, not by these four scallywags, for sure. Now, with that said, welcome, Patrick. We love your stuff. And maybe why don't we kick it off with you giving a little bit of your background for everybody, because you'll do a much better job of it than we will. And then, Richard, sure. I'm going to let you kind of run this. You've kind of got a bit of some thoughts that you want to. So I'm going to let you kind of roll with it, and I'm just going to pipe in where I want.
Sounds good.
All right. Sounds good. So who's first? Me?
Mm-hmm.
Please.
All right. Well, what kind of background do you want? You want like my backstory, or do you want actually just what I'm doing right now? Like
all of it. Well, if you tell us what you're doing right now, and you used to be a trash collector, we might not put as much emphasis on what you're saying. Or we might do more. I'm not sure.
You know what? Actually, you know what? I'd love to circle back to it because when I graduated out of school, I got a job working at CIBC on their at their discount brokerage right out of school. So I was trading just as a kid on there, and I got right into it in 1999. So my first experience was going right into the bubble peak. I want to circle back to that. That's a fun story we can talk about. And then I had the opportunity to work on an investment team over there later on, where I was the trader managing a pool, about a $50 million pool of just option writing. And so all I was doing was premium harvesting, just selling puts and covered call writing, and doing that with over and over again. That's where I cut my teeth and learned everything on options, doing that. And then I spun off and have been in this business that I am for about 10 years. There was a thing that's on the CIBC floor that you can stay 10 years, but after 10 years, you're a lifer. And so you either had to make a decision to kind of go and chart your own course, or you're going to be a bank guy forever. And so back about when I was about 10 years, about a decade ago, I spun off and been doing what I'm doing now. So I'm running big picture trading. and we basically are doing market analytics, and I'm providing all sorts of analysis on the markets, and providing trading opportunity ideas to my members. And I run a couple podcasts, the Market Huddle, and I co-host Macro Voices with Eric as well. And so had the opportunity to just pick, like what you guys are doing, like pick the brains of other people and just have a great conversation to learn. I've learned so much from this process, and it's so great. And thanks for having me on.
It's a pleasure. Isn't it one of the blessings of the quarantine world? This whole idea for us stemmed out of the fact that we couldn't have those water cooler conversations as much.
Yeah.
And we just wanted to have some chats with people about stuff that's investing sort of centered. And it just gave us a great opportunity to sort of share those conversations with other people as well. So
yeah.
one of the hidden blessings of quarantine.
Yeah, for sure.
So Patrick, we know of your options background, but what else do you bring to the table when it comes to your toolkit for making sense of the world of investing, and what kind of framework do you use for your hypotheses?
Well, first of all, I have the blessing of predominantly being a trader, which basically, when you're managing money, and especially large sums of money, you have to follow all sorts of portfolio theory, and you have to follow diversification and all sorts of things as a fiduciary to make sure you're doing everything right. And as a trader, you can be a little bit more of a gunslinger. You can see an opportunity and you can act upon it. So I have the opportunity of being able to be long or short, or be in cash, and have all sorts of flexibility to be selling premium or going long gamma, all sorts of different things. And really, it's about finding asymmetry. It's about where can I find an opportunity where I can manage the risk. There's some opportunity where the risk can be limited, defined in some way, and the opportunity is really great if it works. And it doesn't have to always work. It's just about finding that process. So big picture trading, I was originally partnered with some guys that we were doing a trading program, but they were day traders, and they were just in and out of the market, just trading spoos. And I did it for a while, but I realized after a while that the real money was in catching the really big moves, not just fighting the machine, trying to clip a paycheck down in the trenches, in and out within seconds or minutes. It was more that, look, if I can just catch these bigger moves in the market, just a time where the cycle is, that's where the opportunity is. And that's really where I spun off from them and started big picture trading, hence the name. And it really came about on the idea that you want to use a top-down process. So, and of macro, you want to understand what is actually the unfolding reality in the macro space. And the fundamentals are incredibly important, but they're very hard to market time based on the fundamentals alone, because the trends that are emergent are very much driven by things like money flow and when the cycles are playing out. And this is where I love technical analysis, but technical analysis in itself is incomplete. But in a way, fundamental analysis is somewhat incomplete as well. There's this beautiful way of, I always like to say, I like to technically trade fundamentally good things. You need to kind of merge, you got to merge the whole process together. And so when I'm doing this top-down process of finding my opportunities, I'm looking at what are the big macro trends, where is the timing associated, and then I bring in the options market to try to build the asymmetry in the opportunity. How can I express this trade in a way where I could take it in the right size, know what my risk is defined to, where am I going to take my profits, how I'm going to manage it, the trade along the way, and develop an overall methodology that follows this stream of thought.
And so I want to get a couple of things there. So how do the options help you harness the big trends? I also want to understand a little bit more about maybe getting into how you sort of identify those trends. What are your what's your checklist indicators, if you will? But maybe before we do that, How do the options for you provide that opportunity to harness those big moves?
There are the options market is evolving, so it's not always the same cookie cutter strategy. It has to change. Like, for instance, right now, it's very challenging to, for instance, put on a Bitcoin short. With the options market, like you can use something like a MicroStrategy or one of these companies that have fully listed options that are committed, but the skews and the volatility premiums mean that it's not very asymmetric to buy a put option outright on this market. So you can't say I just use options. There has to be the right conditions for the setup in order to build a trade that way, and then you have to be creative on how you construct it. But options are to me, the convexity in being long options is something that I find a lot of kind of tactical ability to put on trades in an interesting way. So like a lot of people don't like the theta burn. The idea that when I buy this option, I have a defined time frame. My option is time decaying, and it's going to cost me money. There's a carry cost to expressing the trade with an option. But I look at it from a little bit of a different perspective, where I remove substantial amounts of risk beyond that premium. Often, one of the reasons why traders need to, or investors and portfolio managers need to anchor off of diversification, is because it's one of the most commonly accepted ways of managing risk, right? Is that you diversify with uncorrelated assets. But I could take on a very concentrated position on a theme that I feel incredibly high conviction on, and I can define my risk to a set amount of the portfolio, and it's an absolute risk. So if I say I'm not willing to risk more than 1 or 2% of my portfolio in maximum loss on this idea, I could still have even a 20-30% allocation to the trade idea, and still be able to define with an option my risk to that limited amount. Now, if my high conviction idea comes to fruition, I'm levered up properly and exposed to grabbing that return. While somebody that's over diversified, the obstacle with diversification is that while it diversifies risk, it also dilutes chances of making big returns. Because one thing that's working, the other thing's not, and you're getting the average return, and it's more of a methodical rise, and that's great if you're managing someone's a multi-million-dollar net worth. But when some investor comes in with $100,000, they're not looking for a 7% return. They're looking to make a meaningful return on their money, so that they can actually watch their money grow. And so each one has a different way of approaching it. And while there's a lot of investors and money managers such as yourselves that focus on the very traditional role, and there's nothing wrong with that, but I try to present alternative ways of approaching it and finding interesting ways of managing the risk still, while leveraging up for those opportunities that are my big favorite themes.
And so how do you think about the sizing of those positions? I mean, you're not relying on a grand portfolio construction theme. Rather, you're being sort of more opportunistic in the themes that you're addressing. How are you thinking about that position sizing? How are you fitting those different moving parts in the portfolio?
Right. So I use a very I'm a trader. I'm not a portfolio manager. So I use a very trader approach to the sizing of my risk, which is it's a percentage of the portfolio. So if I'm sizing my risk to 1% or 2% per trade, then I'm working backwards. So if I'm trading $1 million, I can go in there and I'm sizing the trade based upon knowing that if everything goes wrong, I'm going to get nipped by 10 grand. Right, like that's my exit. That's where I know, and I can take on a trade as big as I want, so long as I can bring my risk down to that amount. And I think that that's a compelling way of approaching it. And what I love doing with options is being able to, through this process, leverage up the portfolio to considerable leverage that most people would find gut wrenching. But I'm able to do it because I construct the trades in a way that each of these risks are defined. So I'll give you an example. Let's say I went long gold. And I turn around and gold goes up, let's say 3% or 4% on the upside. And what I often will do is sacrifice the immediate returns that I've made to buy a protective put to actually hedge or lock in that gain. Now, I basically use the capital gains that I've earned to actually finance the insurance, but I've actually made it a risk-free trade because now the put has actually is paid for by the capital gain. Now I have 100% of the upside and all the downside risk has been removed. Now I can turn around and leverage into a new opportunity because this one that I'm long is already been constructed into being a risk-free trade. This type of methodology is not commonly utilized in our space. There isn't too many people that approach their methodologies that way. But so long as you are developing a way of always managing risk, that's the first thing. Like when I train traders, I say, stop calling yourself a trader. Call yourself a risk manager, because the first thing you have to do is always manage the risk. The profits take care of themselves. If you get enough of the trades into enough trades, just by accident, you're going to make money on the upside if you get into enough opportunities. But what it is that we, especially retail investors, fall into a trap where they can't sell a loser. They can't sell something at a loss, and they go down the spiral of allowing something just to get bigger and bigger and worse, and the damage that it's doing to your portfolio traps them. There's that saying that on Bay Street, at least it was my day, where it's like the definition of a long-term investment is a short-term trade you're losing on. I don't know. Have you guys ever heard that one?
Oh yeah. Oh yeah. And that trade just turned into an investment. I'm now a long-term investor.
Yeah. And so what I love is the way that when I construct a trade, there's always, because an option has a defined time, there's also an inherent exit strategy built into it, which is that if it's not working, if I bought a 1 month protective put, just for simplicity's sake, if in 1 month it's gone against me, there's a forced exit coming at expiration. And it forces me to go back to cash and reevaluate. Well, maybe I was wrong. Either I was early. That's what we always say. We're never wrong in the markets. We're just early, right? So either you were early to catching the cycle, or whichever you're looking for. You have to step back, reevaluate, and then when you do that, you're looking at, well, should I get back in? Should I should I be allocating the money to another opportunity that has developed since the last time I was looking at the markets, right? And you're always reevaluating it, and that's there's a fluidity to trading that way, and it's not easy for anyone to just do. You have to develop an actual trade plan for following these types of rules and going through it.
Can I dig a bit more into that trade plan? So different traders have very different perspectives in terms of the timeline that they're looking at, long-term, mid-term, short-term, and also what tools they're using to evaluate it. So technical analysis is fairly popular. Fundamental, understanding what is happening at global macro scale. What do you lean on most?
Well, I feel that the biggest money is always made when you're lined up with the big macro fundamental, right? Like you could trade, for instance, gold to the downside. So you could be a technician and see that it crossed below a 50-day moving average, and some technician says, I'm going to short it, and then they're going to hit it. But there isn't a macro fundamental reason, in my opinion, to be short gold. And therefore, that's just a very short-term trade that may not even have very much asymmetry in it. It's just an opportunity for a trader to clip something if they're lucky. But catching the next big a breakout on the upside during a reflation impulse in the markets, there is a big upside. And so I'm more inclined in that circumstance to trade in line with the macro fundamentals of the narrative that we build. And I'm using only the technicals as an action point, because when you're dealing with options, you have a defined time horizon. And therefore, you need something that's an action point saying, this is when I should act upon the opportunity, right? And if you just buy it on fundamentals alone, you almost have to buy the underlying, because you might have, like a value investor, you might have to have a 3 to 5 year time horizon on holding something like that, and that doesn't necessarily lend well to options trading, which have these much shorter time horizons and you're suffering theta burn, carry costs, all sorts of different things built into the trade. And so when you need to have some degree of market timing when using options, and that's where you have to. But macro, having some sort of bigger macro landscape that you've built, and I have the opportunity of listening to so many really smart macro investors come on to our different shows. It helps me construct a base narrative of what I think can happen. And then I'm always stress testing it against the technicals and the charts to see, well, is that the unfolding reality right now? It's great to have
player just a bear all the time. Isn't everything, every macro is like it's always going to blow up?
If you listen to macro voices, then obviously that's the case.
He's talking about gold.
Signal, aren't you?
Yeah, he's mentioned gold as an example a couple of times, so I'm guessing he's pretty long gold at this point.
Sorry.
Go for it.
So you got the macro level, you got your technicals. I've also heard you talk about like on the options expiring and flows and triple witching out. Like there's certain flows information that I think you use as well to help you with entry and exit points. Is that right?
Well, those flows are much more relevant to things like a week in, week out timing, like the gamma pin, which is a common thing that is develops into an option expiration, is just the fact that dealers have to be buying and selling that many more futures in order to keep themselves hedged out. And therefore, there's a natural pinning effect to the market. And so if you're trading, let's say, a 1 week out option, expecting big volatility, and you're doing it into an option expiration with a huge gamma pin, you're fighting a natural resistance. You'd have to have a true macro catalyst emerge to really unpin the market and drive an impulse move. And so it's more that doesn't drive my macro narrative. That's more getting into the granular parts of the short-term market timing. You know, the way Kevin and I on the Market Huddle always talk about is that when the Market Huddle, we're like two traders in the trenches. So like if it was like World War I and we got bullets flying over our heads, like you're out right there in the trench on the front line, while a lot of macro traders are out, the generals in the back. You know, they're sitting there making this is the big picture of what's happening, right? And traders, you're right in there. You're in the grind, fighting, to get the better fill, to get the perfect execution. And so it's a balancing act. The macro is something I lean on. It's something I always have in the back, but there's no point in for instance, I'll give you an example. I was for a long time. I was always talking with Brent Johnson, with his milkshake theory, and I got to spend some time with him down in San Francisco, and we always shoot the shit. And for the longest time, I subscribed to the view that dollar strength was a narrative, but there was a technical backdrop for it. There was a technical uptrend in the dollar for years. That was something that I was able to see. Well, there's a macro narrative, and the trends emerging on the charts are confirming that macro narrative, and I'm going to stay. But as soon as that dollar trend shifted, and as soon as we saw the liquidity flows shift, and as soon as the dollar became incredibly distributed, well, Brent's on his own. I'm going to adapt to the unfolding reality, and if the dollar bear here is coming in, well, if I got the story wrong, well, then let me go to the drawing board and what could be the story. And you have to go and rethink it and ask what is happening that's different than what you originally constructed in your macro narrative. And it's always a stress test. I find being a good trader involves a large amount of humility. The more I find someone that is a cocky piece of shit, that is so sure they know exactly what's going to happen, you know that you do not want to take that person's advice, because there's going to be a moment where the market is going to school them.
Question your priors, right?
Yeah, a good trader is always willing to stress test their ideas to see whether they got it right, and have the mental flexibility to say it's not working. There's something different happening, and I'm not going to lose any more money trying to force onto the market something that isn't happening. You have to be able to be
constantly updating your priors.
Yeah, absolutely.
I was so cocky, I became a quant. I plowed it over and over again. I'm like, okay, some machine needs to make those decisions for me.
So maybe to summarize, Patrick, you're looking for convergence between the technical analysis that you're using with the macro backdrop of the narrative. Sure. And you're looking for that convergence, and you're expressing those views through options because you're looking for the symmetry and the limited loss and the asymmetry of the gains that you can get from the options, right? Yeah. And are these primarily exchange options, or are you looking at OTC?
Yeah, unfortunately, I'm not a big enough trader to go OTC yet, so I don't have my ISDA account. I predominantly focus on exchange traded options, and rightfully so. There's good liquidity, and all of my members and anyone following my work can actually replicate what I'm doing if they like the idea. And so exchange traded options are for sure the better way that we always approach the markets.
What sort of indicators or data sources are you using to track the gamma pin levels and those types of sort of very unique viewpoints?
Yeah. Well, I'm very good at cherry picking other people's work. I don't actually do my own gamma calculations. So we're good friends with both Charlie McElligott and Brent Kachuba over at Spot Gamma, and we have a good relationship with them. So we get their work. So the one thing that I'm a trader first and foremost, so I don't get in the trenches doing my own analysis all the time, especially when there's smarter people that are allocating all of their time to come up with the data. And why am I going to go and try to am I creating alpha by trying for me to get an edge over them? Or are they giving me the backdrop of their information for a small subscription fee, and I can now go on and trade, understanding the data that they're producing? I mean, you want to understand who's creating the data and how they're creating it, and is it good data? Is it relevant? Does it add value to your trading? You have to go through that process, but I don't mind allowing other people to do the work for me. And so these guys are pretty good. So as the Spot Gamma site is a great low-cost subscription site to give you the levels. He does a great job over there.
And that makes sense. I think, Richard, I think you summarized it as you got the convergence between the global macro, the technicals, but also I think this idea of understanding the flows and the gamma is more about avoiding landmines when you're trying to put your trades on, right? An important thing to think about.
It's an important consideration, and generally, what we have seen is a substantial growth in the use of options. Actually, if you share the screen over here, let me just see. This is actually a recent chart from Brent Kachuba over at Spot Gamma. And what this is actually showing, the blue line, what we're looking at here is taking the difference between options that were purchased to open as a buy versus selling to open. So how many sellers of premium are there versus buyers? And in blue is equity call options. And what you're continuously seeing today is that all of these Robin Hooders and all of these new wave of traders that have come in this COVID period, where it's an amazing phenomenon, by the way, what we saw. Let me just zoom in on this, so you guys.
No, that's good. I just wanted to see that started getting out of control January 2020. Is that what we're seeing?
Yeah, but no, it was about April. It started to really spike in April, and what we had was a wave of people that basically were stuck at home getting CERB checks, and they were like, "I'm going to be a day trader." Like it's amazing.
Gamblers that became day traders.
Yeah, it's amazing the phenomenon that we saw in this. I never would have predicted in a million years. I was so shocked to see how this post-COVID period emerged. It was I would have never been able to have predicted this the way it played out in a million years. But it is the conditions from we are. But anyway, the point here that on this chart is showing the equity calls. And what it's showing here is that we have ever increasing amounts of traders buying to open call options to rent the upside of the market. And it's becoming an increasingly popular thing to do. And that is just evidence of the froth that is currently in the markets, this air of easy money where everyone just can go, like just the amount of stuff that you see on TikTok now with these people saying it's really easy. I just look for a stock that's going up, I buy it, a week later I sell it, and look how much money I made, right? Like these guys, like that's the new investment strategy of 2021, right? And so a lot of these traders are using call options to do this. And that shows a lot of froth, but it also shows that someone's on the other side of that. So if retail investors and institutions are net buyers of calls, who's the seller? The dealer. And so the dealer is short gamma. And now what happens is that as the gamma on these options into an expiration is coming up, they're actually going to be suppressing this. Oh, it depends actually what the conditions are, whether they have to buy up the market to the upside from there. But option flows are a big deal now. They weren't a big deal a year or two ago. Like when I started in the options business, I thought this was my little secret thing. I'm going to just be, me and a bunch of traders are going to take advantage of the options market. Now everyone seems to be an options expert. It's like a rolling. There's that one guy that turned 20,000 into 2 million doing Tesla calls. Over the last thing, like all of these crazy stories of people that are just rolling options, and it's created a bit of a fever on this. But we're finding ourselves, what you see here on this chart, we find ourselves where actually in the exchange traded options market for put options, people are actually net sellers of puts, while there's an extraordinary ratio of people that are net long calls. And that just shows just we're at a stage of sentiment where easy money is in the air. It's like this is easy. Just buy the calls and make money. And what's interesting is the last two times that we saw this in what Brent was talking about here was January, right before the COVID drop, and again in August. Both times that we were in similar conditions to today was right before some sort of mean reverting market correction, or in the case of January, it was actually quite a severe market crash. But paying attention to this kind of extremes gives you clues as to when things have gotten a little frothy, and maybe there's not much asymmetry in being long. It doesn't mean the stock market can't keep going up for a couple more weeks. It's not like I came on your show and I'm marking the exact market top here and calling it, but you know that at some point there's probably more downside risk than most people are comfortable with, and especially there was a chart. Let me just see if I can dig up this chart. Hold on a second here. But there was this chart showing here, I have it right here. These are two other really interesting sentiment charts. This was showing on the right-hand side. You have it's from Citibank research, and it's their panic euphoria model. And we have now reached a point in their euphoria blowout that has surpassed the 1999 peak.
So
now.
Sorry,
you could push back. I don't want to claim there's a market crash coming like 1999 per se, but what we do have is a market that's incredibly frothy, and the air of easy money's there. And what I do know is that through history, whenever traders and investors get so sure that the upside is the only path, the market plays the role of the great humiliator, and teaches everyone a good lesson as it drives a liquidity correction on the other side. And so right now, I'm not seeing a lot of asymmetry in pressing the long side of this market. There is definitely the path of least resistance. Like the S&P measures out to 3,900 or maybe even 4,000 on the upside. For the maybe next week or two, the market may very well tack on a few percent. That is actually something that I would accept as a very reasonable probability. But you're almost trying to squeeze a couple percent on the upside, knowing you're going to get caught in a 10% market correction. And of course, I'm talking trading, not investing. But as a trader, you're trying to scalp a couple percent. Now, does that sound asymmetric? I would never take a trade like that where I'm going to try and make 2% at the risk of losing 10, right? I look for the exact opposite ratio where I can risk 2 to make 10. And so right now I'm very cautious about the markets. Things have gotten really frothy. Everyone is so sure Janet Yellen's going to take care of business. And I'm not so sure.
So have you spotted to buy Bitcoin?
Sorry? Yeah. Bitcoin for sure. Yeah. No, I'm a no coiner. Sorry.
So are there any asymmetric trades to the downside at the moment where you see the limit on the upside and there's a potential asymmetric trade for you on the downside, or in this type of froth, is that folly?
So I always position myself on the short side of the market by rolling straddles, and it's a little more of a I don't know whether you guys want to get me into this, but the point is that by rolling straddles, your call option often is offsetting what you're losing on the put while you're actually trying to discover where a market top is. So it doesn't involve any real market timing. The problem today is the market has got so much momentum that it's a dangerous proposition to short. In fact, I've dabbled with a couple of shorts and had to cover them pretty quick because it's not yet a market that is ready to be shorted. There are different strategies you can do to try to kind of position yourself that you have skin in the game if the market turned, or a way of reducing the volatility of your portfolio by having some of that downside hedges built into your portfolio. And actually, that's one of the strategies that I think is really useful today is what I'm doing in a lot of cases. I'm actually rolling equity long positions I have into deep in the money call options. And what I'm converting there is that a high delta call option is actually in some degree or another synthetically behaving the same as the underlying. Now there's tax considerations. If you have big capital gains, you've created a tax disposition and other considerations. But when I roll into that, you've actually created a convexity in the position that if a market correction starts, you actually the worse it gets, the slower your loss is incurring. And so it's about the natural convexity of delta. And so you have a situation where in these periods, I might not necessarily be shorting the market, but I'm positioning myself that where I'm not going to get my face ripped off if the market does start a liquidity event to the downside, and I have ways of managing the risk out, and that's one of the things I actually pride myself in the portfolio. Like in the portfolio that I have there during the entire COVID crash, I only experienced a 7% drawdown on my account during the whole period, because I was able to offset so much with the way that I positioned it, and then I was there for the turn. And so you want to find ways of using options. And then that's another thing. Most people, when they learn about options, they immediately associate with speculation, with leverage. I'm going to go and with a $10,000 account, I'm going to control $100,000 of long equity, right? They basically using the option as a gambling tool, as a way of getting a big return, and then you can parade all over the internet and look at my 500% return on this position, right?
Nassim Taleb did amazingly this year.
Yeah.
So, 25,000%.
Yeah. But what I like to look at options as a risk management tool. To me, it's about how do I make sure that when the left tail risk kicks in, when the market really starts to get ugly, that my portfolio is not getting killed. How am I reducing the overall volatility? When you do that, especially for people such as yourselves that are like looking at Sharpe ratios or Tino ratios and all this stuff, the volatility or standard deviation of your portfolio becomes a big consideration. If you can reduce the overall volatility that you're experiencing, you're going to have much better numbers coming out in terms of your performance and whether you're creating alpha in the portfolio, right? And so I like to look at options as hedging tools.
I think this is like an interesting part to get into, and really comes down to cash management, right? I think, I used to be a poker player, and when you're going into the table, you're not getting 100% of your bankroll and going to play no limit hold'em, right? You would need to have 100, 150 times whatever you're playing, so that you can survive the ups and downs of
the drawdowns,
right? The drawdowns of your cash flow. I can't imagine you're going out there and putting all of your money in options that have data decay, that have,
absolutely.
So you have to, how do you manage, I guess is the question. How do you manage your cash, generally speaking, given that you really are getting non-recourse leverage? So you can do a lot with that.
Yeah, you know what? It comes back down to what we were talking about at the beginning. I actually size my risk as a percentage of the portfolio, very similar to your example of using gambling. What you're trying to do is size your risk. So a lot of traders mistakenly are saying, "I believe this will happen. This option position will make me the most amount of money if it happens," and then when it doesn't happen, they have their faces ripped off, and they take monstrous losses because an option has to be considered an absolute risk. Like an option gets zeroed when you're wrong, and you have to position in your portfolio based upon sizing the trade that is actually a realistic chance of happening, and you have to approach your trades. But when you're building asymmetric trades, and so this is where we could talk a little bit about the difference between trading and gambling, because when someone goes into a casino, they're looking for a probability edge. They're looking for an edge where the mathematical probability is better for me, and at this moment, because I counted the cards or I did whatever, and now I'm going to start betting because I know that I've got the edge. For me as a trader, I look for my edge in the asymmetry of the trade and not the probabilities of the trade. In fact, sometimes I might only be scoring a 40% win rate, but sometimes I'm getting a 4 or 5 to 1 payoff. And so even though I might be losing even more often than I'm winning, if every time you lose $1, but every time you win, you're winning 3 or 4, then even with a 50% success rate, you're raking in huge amounts of money. And so I don't focus on claiming to always be right and never wrong, and I found some secret holy grail where all my trades work. No, I have a good whack of losers that come in, but I can actually contain the risk, manage the risk. I have a way of managing those losses down down to small paper cuts that are just a part of the trading process. And then I'm there for the big picture move, that big move that you catch and win that big payoff. And that has sometimes one trade will make me more than I lost on 6 trades, right? Like
I think you're nailing so a couple of things. One, investing is something, and it's very different than trading.
Very different.
The business of trading
Yeah.
is what we're talking about here, and you have to have the trading plan and do this in an extremely disciplined way. You're taking these very small portions and hoping to get large payoffs, almost like a VC would in an investing framework. Yes. And so that really has to be stated. I want to state that explicitly. So don't try this at home if you don't have the trading plan, if you haven't looked into
the knowledge.
Or the knowledge, right? And if you lack the knowledge, go get the knowledge. Patrick, you've got great information and courses. Use some guidance and that sort of thing. And so the trading side of it is that part is exceptionally important. And then I forgot what I was going to say. And then from a behavioral perspective, when you think about the behavioral edge that you're exploiting, well, think about this. How do people act? There's the bias of sell the winners and keep the losers, right? And in this case, you're saying, no, we sell all the losers. The losers have a very fixed cost, and we beat the winners into full and total submission.
Love it. Exactly.
Right. And so by doing so, what is the behavioral ability for participants in the market to be able to do that? To actually lose on 7 out of 10 trades, make 7 or 8 times the money on the 3 trades, and do that over and over and over again.
So you can improve. It's a trade-off, because if you're going for the big win, you have to ride an option a little longer than someone else would. And so a lot of times a trader might be just targeting a double on an option, and they might be able to hit a winning percentage greater than 50% in the process. And so it's just my style happens to be more that VC model, which is like I want to catch that big macro trend and ride it for everything, right? And I've caught some really big wins doing that way, but there's been a fair share of paper cuts along the way where you're testing the market. Is this where the breakout's happening? Is this where the opportunity is emergent? Nope. I took a loss. I'm going to go to the sideline and reposition, right? But what I love about it is you don't get trapped with your losers. The funny thing is, back at in my very early days at CIBC, one stat that I found out from the discount brokerage side is like 90% of discount brokerage accounts are dormant. They basically are not trading at all. And one of the reasons that is a common thing is because these retail investors start losing on their stocks, and they refuse to sell them at a loss. And then the portfolio just becomes. They ignore it. They just ignore it.
Investment.
It's just it's a long-term investment.
It becomes a long-term investment.
It becomes a portfolio that you're waiting for this thing to turn. And as a trader, you have to always be looking for the next opportunity, the next thing, and you can't get trapped in trades that aren't working. And what I love about the methodology of using options, even though we've got carry costs and theta burn and all these other issues, it forces you out. It forces you back to a neutral state where you can come to the markets again with a clean slate and say, where's the next opportunity? Where's the next position to take, right?
Do you find, just one more follow-on question, sorry guys. Do you find that, last one for me, do you find that when you look at your trades and do you find they follow sort of the Pareto principle then, like sort of 20% of the trades provide the vast majority of the actual profits, or is it a smaller?
For sure. Absolutely. But I think like even if you listen, read some of the top traders in Market Wizards. They'll give you similar style kind of things where it's like they'll say something like, I think it was Tom O'Shea that said that I come up with 34 major investment themes a year and make all my money on 4 of them. It's this idea where you're always trying to find out where is the next big move, where is the next opportunity, but you allocate money to these trades to discover which of them is going to be the trade. And when you discover that, no, this is the wrong idea, I got this wrong, you have to be able very quickly as a trader willing to say, no, I have to go to the sideline and rethink this. Or maybe I got my timing wrong. Maybe this opportunity is good, but it's just going to happen 6 months from now. You have to be able to go back and neutralize yourself emotionally. And trading is completely like investing. Like when you're a money manager such as yourselves and you're going through it, you have a portfolio construction theory, you have a way that you allocate assets and do all of this. But as a trader, you're in the trenches. So it's sort of the way I say, like I was using that analogy of being in a World War I trench and bullets are flying over your head. You're down there in the trenches fighting at the front line, and you have to, and so it's all emotions. It's all emotion. And you, in order to be a good trader, you have to be humble and you have to have self-discipline. If you don't, you're screwed. You're done. Like you might get lucky out right off the bat, but the market will quickly kind of school you at some point if you don't have that ability to have rules, discipline, ability to stay emotionally calm. To ride through that. It's very important things to develop in yourself.
You've talked about the sizing, right? But say you have a position or a trade that you're got pretty big convictions on, and you think that the maximum position there could be 4% of your portfolio, let's call it. How would you go about building? Are you going to break that up into quarters or something and start? And then if that position goes against you, are you willing to add to that up until a certain point? Or if it goes in your favor, but you haven't really gotten to the size that you want, are you buying into that trend going up in your favor? How do you think about that trade-off?
I add into winners. And so because I use Fibonacci's for the predominant technical technique, the first entry is actually incredibly important. There's a tactical thing, and I usually do leg into trades. And so the first trade is always a little bit smaller than you'll ultimately want to be carrying if the position is developing into it being a true winner. And so you start by, it's like a stress test. You're putting your foot in the water with your handle on the exit button, like the eject button on a fighter jet. You're like, get me out of here. Like you're stress testing whether the idea is. And then if the trade starts working, then you build it, and you build it once it's winning. I don't add to losers. What I do is I'll be sidelined, and I'll revisit the trade when it looks like it's setting up again. It just often when the trade is entered incorrectly right off the bat, it's a timing issue. It's a sense that you might be right about the bigger macro story, but you're wrong on the timing of it. Like, it's like, I'll give you an example. Gold just what was it, a couple weeks ago? Here, we could even share the chart on that. Let me show the chart on gold. Where we go.
As you're pulling that up, Patrick, and talking about that, also touch on, when do you consider those paper profits yours, or do you ever? Do you ever consider the paper profits yours? Because the trade starts at a 1% risk. Do you say, oh, this has grown by 30%, and I'm incorporating that, or are all those paper profits sort of not calculated and you just keep your stop or where your exit is?
So this is where option strategies are amazing. And what I often will do is if I believe a market has gotten too frothy, gone too far too fast, but I still really love it in the bigger picture, I want to keep riding this trend for even months more, but it's just gone way ahead of itself on the short term. The biggest mistake I feel traders do is selling. What happens is that once you sell your position, it's so hard to get back in. Once you've let go of a trade, thinking that it's a short-term thing, finding that re-entry is actually one of the hardest things. And so once I've entered at an amazing moment, I never want to let it go until I've ridden the trade to the maximum, and then I walk away. And so what I often will do is strategies such as a risk reversal, or a collar is known as a collar, on top of a position. And so here, like, I'll give you an example, right? Well, first of all, let's just give an example on this gold trade and a failed breakout. So essentially, this entire rally, we were looking at this as the beginning of the next gold advance. We thought that this was a deep enough retracement in gold, and that gold was actually beginning a brand new breakout. And I was early. I was wrong. It did not follow through, and then gold gets slammed on the downside. So when looking at a trade like this, the first position is you go long gold at your tactical moment, and you're going to give it a chance to work. But when a trade proves that you got early, it doesn't mean that gold isn't going to go up. Maybe gold is going to correct downwards and consolidate, and it's probably going to rally. But it might be a March or April rally. Bulling it in January, I might have been 2-3 months early. And so my job is that if I got in too early, I go back to the sideline. That's where I cut the loss. It's clearly my timing was off. And I'm back to cash and neutral, and I'm looking at where is the next tactical opportunity to go long gold. I'm not going to go and average down the position and keep working it. I literally, because you want the emotional reset. You want the emotional reset that I'm back to neutral. Because once that position has gone against you in a loss, you start doing crazy things like justifying why you're long gold and doing all these things. I'm a trader at first. I only want to be in things that are working.
How big is that testing, though? Is that a third? Is that like half of your position? Maybe a quarter? What size of the max?
That actually depends on the options market. If the volatility is very low, I don't have a lot of Vega risk. I can buy the premium very cheap. I might take the position much larger than I normally would, because the options market is allowing me to size my risk very well, and I can be far more aggressive, and getting in early gives me more asymmetry to the upside. But if I'm coming in, and especially let's say during a market crash, volatility is going through the roof, your option premiums are ridiculously expensive. You can be totally right on the option on the market timing, but to hedge it out with the options market is so expensive that it's not the right time to make the big move. And I might trade that position much smaller right off the bat and wait for things to normalize before I'm adding more aggressively. So I'm a very adaptive to the real conditions of the market. Right, you have to kind of size up where we are in the market in order to make that sizing decision. But I'll give you an example. Let's say I want to talk about, let's say, Freeport McMoran, and I was blessed to have published this thing back when it was around $8. We bought leap options out at $8 on Freeport, and we've been riding it ever since. And when this thing hit, this kind of $16, $18 area, all of our leap options were up over 100%. Some of them were 200% return. And every member just wanted, should we take our profits? Should we take our profits? So right. So like we got in somewhere on the breakouts over here, and we're talking about the price over here, right? And I'm like, yeah, you know what? It probably at this moment has gotten frothy. It's due for a correction, but we can't sell it because there's all these fundamental reasons why copper can be bullish, and the conditions in this market can keep working. And why the hell would we lose our position when we have secured an $8 purchase price of Freeport McMoran? Why would I give this up when I have an entire year of time to ride this? We bought the leap option, so we were like out to 2022 on this position. So we collared it. So we bought we sold the covered call above against the position. It's not really a covered call because when you sell against a leap, it's a calendared right. and not an official collar. And then we used the premium to buy a protective put. And so we created a risk reversal hedge wrap. Then when this little market correction happened on the downside, as soon as we realized that that was all that was happening on the stock and it was reversing back up, we removed the hedge and we were still long, and we've been riding it ever since. And so while a bunch of traders would have been already knocking themselves out of the trade up 100, 200%, we're up like 400, 500% on these leaps. And a lot of along the way, there was an infinite number of reasons to have taken the profits. And the only way you make the big money is finding a reason to stay in, and yet finding ways to hedge out the risk that if in fact you got caught in the market top and it was reversing, that I put some sort of a way to protect the profits that I've made. And this is where you have to be tactical about these things, right?
So this is interesting. What made you want to do a leap instead of a shorter term call option? Like, is that a macro call?
Yeah, it was a macro call on the fact that we couldn't believe that they were giving, because we were very bullish copper. Like I remain a commodity bull. I think that we've transitioned into a commodity bull market that will last maybe many years into the future. The problem today is that we're way too frothy on so many of these things. These commodity stocks have gotten almost
well, they're tech-like.
Yeah, they're tech-like. Like it literally has gotten like, if you didn't tell me this was Freeport McMoran, I would have told you it's an EV stock, right? Yeah. Like or some solar play or something. These things have gotten stupid frothy. At some point, they're going to mean revert. I mean, it's not that fundamentally Freeport McMoran isn't a great stock, but at some point this thing could easily print $25 or 23 on some sort of a market correction, and it's just going to be a buy on dip in the bigger picture. But boy, will it be painful to anyone who hasn't hedged it out when one of these corrections kicks in, right? And
okay, go ahead.
No, go ahead. No, I'm done.
Well, I'm just wondering if I'm going to ask if we can shift gears. I'm going to ask my partners if it's okay that we shift gears a little bit from the nuances in the trading, and talk a little bit more about how you paint this macro mosaic, how what are the key macro indicators that you focused on? What are you focusing on now? I'm going to ask you a trail of questions, and I apologize for that. So you're making a macro mosaic. You use indicators. What have you used recently? How have those indicators evolved? Can you share with us about, you being a professional trader doing this on a regular basis, and the changing sort of flight instrument panel, if you will? Has it changed a lot, or are you using a lot of the same items that you've used for years? So creating the macro landscape and all that, go.
Well, the first thing, the biggest change has been the bond market. The bond market over the decade has been a fabulous indicator within the macro landscape. And now that we've really reached a zero interest rate regime, and central banks generally are losing their effectiveness with monetary policy, the signals from the bond markets are no longer as relevant. It's not that they're not. I mean, the bond market can still do something that will freak people out. You can't ignore the bond market, but the macro landscape that I've always had over a decade has dynamically changed in the last year, just because of where we are in that. But to me, it's really one big trade anchored off of the US dollar. So until we go off of a US dollar centric system, that being the world reserve currency, the US dollar is the center of all macro. And it's one of the key, and of course, from a commodity perspective, oil is a very important commodity in that same scope. And so when you have oil and you have the dollar, and they're the core anchors, it becomes the center pin of the reflation trade versus a disinflationary cycle that often is occurring within there. And so the very first underpinning thing that I always look for is what are the predominant trends in the dollar. That has to be the number one thing to watch. And maybe there's a point in the coming future as we transition away from that. I mean, there's so much talk about this digital currency stuff and whether or not some new central bank digital currency will emerge that will dethrone the importance of the U.S. dollar as a the center linchpin of macro. But until that happens, the U.S. dollar is it. And one of the biggest themes that we have seen in this cycle is the derivative of what happens once the dollar begins trending. So the dollar downtrend is one of the key precipitating drivers of the reflation trade. And so once you have that dollar trend in place, then you generally see strength in commodities. And each commodity has its own little fundamental story. It's not so relevant to natural gas as it is to oil or some other type of a commodity. But when we basket commodities as an aggregate, generally commodities are in bull trend in a reciprocal fashion to the dollar trend. And so when commodities are bulling, particularly oil, it becomes one of the key input variables to inflation expectations. And so you notice that the moment oil started to break out above 40 plus on the upside, suddenly all the break evens are starting to blow out and all these different things. You're starting to see inflation starting to be priced into the market. You saw 10-year yields starting to increase, all of the different backdrops of that. And so this is all intertwined into one big trade, which is dollar down and the reflation trade stuff working. And one of the single biggest things to identify is when has this current cycle exhausted itself. And one of the things that bothers me, me and Kevin always joke about it on the Market Huddle, but we both are natural contrarians, and we both hate when everyone agrees with us. And the problem today is the dollar bear is the most consensus view out there.
That's
like
right.
it is
Everyone's
so
a dollar bear.
Everybody is a dollar bear. Now that doesn't mean there isn't a macro fundamental reason behind dollar weakness, but when I always look at it like a boat, and all the traders run to one side of the boat is almost going to capsize. Naturally, intuitively, some of the people are going to run to the other side of the boat to try to level it. And this reaction function that happens is what can cause what I believe is going to be a U.S. dollar short squeeze. And there doesn't actually have to be a fundamental reason behind it. So I think it's going to be very much a liquidity-driven event. It's such a crowded theme. Commodities are overextended to the upside. The dollar's oversold to the downside. And everyone is so convinced everything will continue that the market again plays that role of the great humiliator. You just know there's just something coming. That when I worked back at CIBC, my boss, the portfolio manager I worked for, my boss used to always say, "It's what you don't know, that always hammers the market." And so like everyone was so sure it was the elections that was going to hammer the market. No way the elections were going to cause the event, because everyone saw the elections coming from a mile away. It's been priced into the market. All the outcomes have been considered. It's always the surprise. It's something that we are not talking about on the show. We've been on for an hour and we haven't talked about it because we don't know it's coming yet. There's that one event that's going to cause a sentiment shift, and it's going to cause that incredibly crowded trade to have a counter trend squeeze. It's going to be an event that happens the other way, but I still think it'll be a buying opportunity. I think that the macro trend that's been established is one that will probably be with us for many years, but this is the wrong time to get into the reflation trade. If you haven't been long commodities for the last 6 months, if you haven't been short the dollar for the last 6 months, this is the wrong time to be getting onto this bandwagon.
There's too many tactical players going short the dollar, long commodities. And the macro players that have been playing it for a long time are waiting off. So we need to shake them off.
There's exactly. There's going to be a shake moment, and that doesn't make me a commodity bear. It doesn't make me a super U.S. dollar bull, but there's no asymmetry left in pressing this trade. This is the eighth, ninth inning of this move, maybe, and sometimes in the ninth inning comes a really good run, and there might be a big kind of blow off. There could be some big kind of still one more surge in the prevailing trend, but this is the wrong time to be jumping onto this bandwagon right now. You got to wait for a new tactical opportunity to be playing this storyline.
What do you think are some of the catalysts that might? I mean, everybody would think perhaps the inflation scare, a potential inflation scare. We're definitely going to get a denominator effect because inflation prints were so low because of COVID last year. You're going to get that initial denominator effect. You would definitely have to see a follow through for there to be real inflation, but that head fake might be, or maybe something on the geopolitical end. Do you have any thoughts on the catalyst?
It's an interesting, it might be a reaction function. Sometimes a market turns without a reason, but the media needs a reason, so they make a reason. And so what happens is that you might have a dollar turn, and everyone at that day was when Janet Yellen came out and said something like, we don't support a weak dollar policy, or she'll say something that, and suddenly everyone's like, Yellen ruined the party, right? Like, they'll blame her, but the market was way overdue for the squeeze. It just conveniently was the headline that corresponded with the market turn, and it becomes the anchor of what we use as the excuse why the dollar is rallying. I
love that. Every morning, every day, I look at the Apple stock charts thing. So I know the first thing, and there's always a reason for why the market gained or lost money, right?
Yeah. And it's great.
They got to write something, right? They're always looking for a story.
Everybody borrowed the headline, and that became the thing for the day. And totally agree that it's what you don't know, right? It'll become that later, but it's what you don't know. And I think COVID was one of them. We all knew that COVID was out there. Nobody paid it any attention. We didn't know that it was going to be as bad as it was.
No one cares. No one cares till everyone cares, and they all care at once, and it creates a liquidity event. So it's like you'll have a headline, and no one's reacting, so it can't be that important. And then it goes right. another headline, right. No reaction. That's a thing. It's amazing. It's the part about market timing, I'm going to go off a little tangent a little bit, but the part about the markets that is incredibly different than something like being a bookie and gambling. So let's say I'm a bookie making a book on the Super Bowl, right? The Super Bowl is going to come up eventually here. And let's say I'm the one that's creating the handicap, and I'm putting in everything so that I'm hoping that as a bookie, there's an equal amount of people that will bet on the one team versus the other team. And in the end, I'm going to make my spread for having made the book. The thing is that in the gambling world, it doesn't matter whether I priced that Super Bowl game wrong and everyone bet on team A versus team B, because it has no impact or bearing on the outcome of the game. When those players hit the field, they're still going to play a football game, and they're both teams are trying to win the Super Bowl. And how everyone bet on the game outcome didn't have a bearing influence on the actual outcome of the game. But the stock markets are very different, or macro markets, any markets. There's a self-fulfilling prophecy to the markets, which is if everyone believes something is going to go up, then they buy it, which forces the market to go up, which only confirms to everyone that they were right about their thesis. And it becomes a self-feeding loop that buying actually begets more buying. And this is why I best describe the markets as a Giffen good. Have you guys ever heard the term Giffen good before? No. So a Giffen good is something that defies normal supply and demand. So the normal supply and demand is that when prices in let's say microeconomics, if prices go up, demand should go down. Right? That's your just 101 economics, right? But a Giffen good is that when the price goes up, it actually increases the demand. And a good example is Toronto real estate, right? Because you can't lose money on Toronto real estate, right? And so what happens is that as it goes up, it only actually confirms to everybody that that statement is true. And therefore, that many more people leverage up and go into it that much more, which actually, and this is what's happening with Bitcoin. This is what's happening with Tesla. It's this feedback loop that that everyone wants to be making money where everyone else is, and everyone comes up with a story, and the one that looks they're right is the one that ends up getting more of the money flow. And in the end, it creates that feedback mechanism that's in there. And so we're seeing bubbles everywhere in the market because of this feedback loop of this Giffen element in the markets. And what happens with this is that this loop lasts until it exhausts itself. And inevitably, every bubble exhausts itself, and Tesla will exhaust itself, and Bitcoin will exhaust itself. Every one of these parabolic rises, but until it does, this feedback mechanism, self-confirmation, keeps money flowing in there, misallocated to something that has no fundamental basis being where they are. The problem is with individuals like us that actually understand fundamentals. You start looking at the balance sheet and the management and all this stuff, and you're like, what the hell is going on here? This makes absolutely no sense. But yet it's actually the market taking a life of its own based on these feedback loops that actually is what happens. And so as traders versus like as money managers such as yourselves, you have to actually have a fundamental reason for buying a lot of things. It's hard to just say we're getting in just because it's hot.
Well, I think what's the professor? I can't remember his name. We've talked about him numerous times, but he studied bubbles in university settings. People coming in.
Vernon Smith.
Yeah.
Vernon Smith. That's it.
So what he found is that, listen, there is a predictable shape to these bubbles. Like it can tell you this is something that human beings do. What I can't tell you in 30 years of doing this is when they end. Right? They look very similar, but trying to time these things, maybe he's not a trader, so he probably hasn't figured it out. But it is interesting how there isn't a pattern that's so obvious that everybody can get it right. Right.
So
how you manage that fact?
Well,
how you position your trades and whatnot, but are you very defensive right now because of all this?
So what I've learned the hard way of trying to catch market tops, because I pride myself on I'm one of those guys that tries to be a rock star and actually catch market tops. It doesn't work most of the time, by the way. I'm not trying to you have to be very brave to attempt it. But what I have learned after 10, 20 years of trying to trade this way, that actually catching the very first blow off top is actually the wrong top to catch. Actually, here, let me share my chart here. Let's take a look at Bitcoin here for a moment. And I'm going to go back to...
We're going to get a lot of hate.
That's okay. That's actually a very good sign that the market top is close. Is that when you
no coiner we got here on the channel?
Yeah, exactly. Anyway, but the point I want to get at is forget this current state of where we are. I want to go back to the market top from this was let's go back to 2017-18. Right. And so here was the parabolic rise of Bitcoin back into its 2017 peak. Right now, you can sit here exactly to what you were saying. It's so difficult to try to catch the top. Like to say that I know exactly where this is going to stop is nearly impossible. Because this thing is like a freight train moving down a track with all this momentum, and you trying to be a rock star and standing on the track saying this is where it's going to stop, you're just going to get run over. But after a bubble bursts, there tends to be this pattern, which is it sells off and then has a failed rally. That is where you short bubbles. You don't short into the parabolic rise on the upside. You actually wait until the bubble has actually broken, and then is when you actually are engaging the downside of the short. So you don't ever try to catch the actual absolute top. You first wait for the bubble to burst, and then you engage the short side after it's burst. That's what I've learned. So I've stopped trying to catch the absolute tops. I wait for the excesses to actually turn, and then I'll start short selling.
So does it work on the flip side there? So April 2018 I don't even know. Was that the bottom? I'm also a no coiner, by the way, or a very tiny coiner.
Yeah. No, it kept bleeding. It kept bleeding all the way down, right? Like it went all the way down to 3,000 from 20,000, right? 85% wipeout. That lasted over a year, right? And this is the cycle. This isn't about Bitcoin. This happens to stocks all the time. This happens
I think gold 2011.
Absolutely happens to gold. It happens to everything. Like this boom bust cycle is the nature of what happens in markets. You allow markets to be free trading. Human nature creates these boom bust cycles. And all I'm trying to identify here, I picked on Bitcoin, but the point is, don't try to catch the parabolic rise and the top at the very peak. You wait till the bubble's broken, and then you short it. Is the way I would put it. That's my word.
What do you think about the macro narrative that's been going on? I mean, the narrative now predominantly says that there's institutional money coming in. They're putting in all the guardrails so that you can get the big endowments, the big whatever. The institutional money is now really contemplating this as a serious asset, and that is allegedly one of the reasons why this thing has gotten so frothy, all the way up to 40,000. How do you square that with your technical analysis?
Well, listen, I'm very suspect that these institutions are long-term buy and hold investors of Bitcoin. There are these big institutions that are allowing their prop traders to go and try to profit from the upside, but there are hard stops on prop traders. And as soon as Bitcoin starts going down, these institutions that are buying on the way up are just as going to be selling just as fast on the way down. I don't subscribe to that. And generally, while I do believe there's a digital revolution in currency coming, I don't believe it's going to come on a private currency. It's going to be a government based digital currency that is ultimately going to prevail. Because if you think about it, while we can be capitalists and we can say markets should be free trading and privatized and all of these different things, money is a social contract. And even though a lot of people get disenfranchised by the idea that money is fiat and they can create it anytime they want, there's an actually important function to that. For instance, let's just say there was a disaster. Let's say in North America, Yellowstone blew up and half of America is covered in ash. And there's a huge natural disaster that happens. In the end, the ability of a government to run massive deficits to support people, to clean up the mess, to do all of this, that's how they funded World War II. This is how different things happen. Governments need to be able to access money, and the natural way of doing so is by it being fiat. Even when it was backed by gold, as soon as a crisis happened, they would drop the gold standard and immediately turn it back into a fiat currency. That's happened through history over and over again. And the idea that we're going to have some private digital currency like Bitcoin, where something, what is the statistic? Hopefully I'm saying it right, but something like 98% of Bitcoin is controlled by like 2% of the wallets. I don't know what the exact, or 90% of Bitcoin is controlled by 2% of the wallets. So you have, in a world where wealth inequality is the biggest issue, we're going to have these private wallets that we don't even know half of these people who own these, where they own who they own taxes to, or how this money would even be allocated. What we're going to do is we're going to take Bitcoin to $1 million and allow these people to become multi-billionaire, if not trillionaires, for what? Like our governments are going to create digital currencies that are. I think Bitcoin is the Palm Pilot of the 2000s. It's
my Palm Pilot. loved it.
Exactly.
What did
And
you
you know
do?
what? At the time, it was the technology. It was the big thing. But this revolution that's happening is going to be dynamically different years from now. And Bitcoin is just going to have played an important role in developing it. And I don't think that Bitcoin is the end game. There's a much different way that the cryptocurrency story is going to play out. And maybe we don't even. You don't even need to know it. It's not going to be Bitcoin.
Right.
It's going to be something different.
So Bitcoin is Netscape.
Netscape, exactly. Yeah.
And
Yeah.
the next, the Google, we just don't know yet.
So,
there's
Patrick, let me ask you a question that I've always wondered. Whenever I speak with a trader, with a prop trader, it's super exciting. You guys are at the cutting edge of trading. You live and die by the market every day. You're trying to come up with the latest and greatest idea, and you're cutting losses and you're taking more losses than your gains. But you have, generally speaking, the people I know have a very good outcome, very good returns. And yet I don't find any pension plan, large institution hiring an army of prop traders to represent 100% of their assets. So I'm curious to understand what the aversion to traders like you to add value to large pools of money is. Is it that just your capacity constraint?
First of all, what I would say is there's a very large failure rate in trading. So this is not something that this is the secret, the holy grail. You just got to learn to buy when the moving averages cross over and there's a green signal up or red signal down, and you've got it figured out, and you're going to beat the market. The second thing is that it's easy as a small trader to outperform. So, and a small trader, I mean, you're whipping around millions of dollars instead of billions. Once you get big enough, the way I describe it is that big portfolios and pensions and things like this, they're like an ocean, sort of like a barge in an ocean. There's this huge immovable object, this monstrous thing, and traders are like little tiny speedboats that are doing donuts around them and able to have the flexibility of being able to adapt. But as soon as you try to move that barge the same as these little speedboats, you can't. It takes a mile to turn that barge. When you're managing big money, trading starts losing its effectiveness. You need to find an edge. It's often you have to be small. You have to be nimble. You have to be able to get in and out of the market and no one know that you were there. Once you start, like, this is why you have to have so much respect for the Stanley Druckenmillers of the world, because they did it, but with big money. Not like, like I could turn around and be whipping around seven figures, but I don't know whether I could ever do that with a fund that large, right? Like it's one of these things where size matters. It really does, right? And the second thing is that to become a good trader takes a lot of training. It's not a part-time endeavor. And this is the thing that's why I laugh when I see all these TikTok things about all these people that seem to have figured out during a market bubble how to make all this easy money on the upside. Becoming a good trader is a lot of pain along the way, a lot of mistakes. And you have to endure the school of hard knocks of learning through trial and error on actually how to find your edge. And there are a lot of times where the market changes. So you work really hard to get an edge. And then suddenly a year or two later, the market evolves and your edge is gone. And suddenly now you have to almost reinvent yourself as a trader. And this is where portfolio managers, you anchor off of the long-term appreciation of equities, things that happen in a slow and steady course, long as you stay the course over a certain time horizon. And for most people, that is a much easier way to go down the journey. Trading, you take so much punishment that you have to really love what you do. You have to love the markets. You have to love trading. You have to love being there in the trenches and doing this. If you don't, if you're doing it only for the money and you're not doing it for the love of trading, you're going to fail. You have to because you have to feel the markets. You have to understand them. You have to become almost one with them to be able to size it up. And you know, there are people that are dedicated to it, and I love working with people that want to take that journey. But there is no I shouldn't. I don't want to make it sound like those TikTok traders have got it figured out. It's actually harder than
it's amazing those TikTok traders how
they got it all.
They're even legal. They're legal to go out there and say what they're saying. It's amazing. But yeah, that's
just too many of them are. There's too many of them for anyone to regulate. You can't go into, like, how do you go and stop someone, just some random person saying it? Like, when you're a regulated institution and you go out and say something, it's easy for your regulators to come down and bear down on you and say, you can't say that, right? Like, but once you're just a Joe Schmo on a TikTok account, you can say whatever the hell you want, and who the hell is going to clamp down and remove you off of the internet, right? Like, and this is why there's so much misinformation out there, so many misleading things. This is why I believe there has to be some sort of event, because through history, like I'll leave it at this for you guys. Like, I remember back in 1999 as a kid, you know, I'm this 23-year-old kid just coming onto a discount brokerage account or brokerage taking orders, and back then the hot shit was Nortel. Right? Do you guys remember this?
Oh yeah.
Nortel was the hot shit, and back then, one of the drivers behind it was the fact that Canadian RSPs had to be 80% allocated to Canadian equities, and banks and resource stocks were dog shit back then, and so the only thing you could own that was making any money was tech. And there was only a handful of things you could own, like JDS Uniphase, Nortel, that kind of stuff. What was the other one? There was
the cable one. It spun out.
Yeah, but anyway, so there was only
BlackBerry also in that.
No, BlackBerry was 2007. That was the next bubble. But back then, Nortel, and so everyone, just the way everyone's talking about the easy money of Bitcoin today, back then everyone owned Nortel. I mean, at its peak,
like 40% of the TSX 6.
Right? No. It was the composite, and BCE and Nortel combined were 30 some odd percent of the entire Canadian capitalization of the entire Canadian stock market was in two stocks, and I just remember the froth back then. And I remember the story of this one guy that phoned me up, and Nortel at the time was trading like $120, and it came down to like $90 a share at the time. And it was going into its earnings. And this guy had his entire life savings in Nortel. And he basically calls me up. And yeah, I'm not allowed to give advice. It's a discount brokerage, and he says, "How many shares of Nortel can I buy on margin?" And I basically go and pull out the calculator, and I say, "You could buy another 1,300 shares of Nortel." So this guy goes from like 700 shares to 2,000 shares at 3:30, right before the earnings announcement on the close. Nortel goes and buys it, and Nortel goes and gaps from like $90 to like $60 a share on the earnings miss. And this guy's account goes from being worth like 70 grand to being worth minus $5,000 the next morning. And then I had to give him the phone call to tell him he's getting margin called. You know what the guy does? He sells down the position and goes and gets a line of credit to meet the margin call on the other part of the shares, and then loses that too. And so my first taste into this business was watching severe destruction. and people losing a lot of money in bubbles. And so when I see today the kind of froth that is, it just feels so 1999. Now
people saying that the markets have become more efficient. I think we can say in 2020 there's a lot of inefficiencies out there.
There is a lot of inefficiencies, but it doesn't mean that there
efficiency is about market clearing, though. Let's be honest. Like the market clears, it's efficient. Herding is
still very much alive.
There are the bubble stocks, right? Like a lot of those EV names and other things. They're the ones. Like I don't think like if you own Enbridge and
I have to go, guys. I got to go to another call. But Patrick, thank you so much. You guys wrap it up. I'll talk to you soon. Thank you again.
Thanks. All right, cheers.
Bye.
But like I don't think that when this turns, that like an Enbridge is going to get hammered, right? Like these are stable stocks with real fundamentals, and they're basic. And so when you're building a portfolio and you're properly diversified amongst high quality names, you're going to be fine. But if you pumped everything into one of these EV stocks that has gone 500% in the last a month, at some point the people that are buying this thing are going to get their faces ripped off on the other side of that, and so it's going to be so interesting to see how this plays out. I know it ends badly, but when will it turn? What will it look like? What's going to go down and what's not?
How long is the easy money going to be around for?
Yeah,
it's a big function of where interest rates are and the opportunity cost. And
I'll tell you what, you guys can invite me back in the midst of the turn. We'll each grab a bag of popcorn and we'll sit here and we'll watch real time as the carnage. But I know I don't wish any harm on anyone, but everyone's got to realize that this isn't the market is perceived to be easy money, but it always has a way of correcting. It has always a way of those excesses being mean reverted, and a lot of people always get hurt during that. So just be careful is the way I'd leave it. People have to realize that if you're trading that really hot shit, you got to par it off a little bit. Make sure you're not leveraged. Make sure that you have some other things that can buffer it. Maybe find ways to hedge it. You got to be a little bit careful.
Yeah, I think you said it earlier how difficult it is to trade. I mean, we've been in the markets forever. It is the most competitive landscape on the planet.
Yeah. And
so if you think you're going to be a weekend warrior of the markets, you're kind of in trouble, right? So, I think, going back to the original stuff of what we always talk about is if you're not going to play full time, diversify, have that kind of general growth. Make sure that you diversify in your stocks, your bonds, your gold, your commodities, get a little bit of everything. Yeah. And if you're going to do it, take it seriously. Know that you're going to take some licks as you go along, and try not to get enamored with it during the bull market because
the odds are against you at the end of the day.
Your formative years or formative months end up being this massive bull market. When you open up a TikTok and you say, "This is how I buy." You see when this stock goes like this, that's when I buy. And then it goes, I buy some more there. I'm legitimately seeing these types of, and you saw that in 98, 99, people leaving their jobs because they were making more money in the stock market than they were in their jobs. This is, in a way, many aspects of the market right now are there. And the euphoria, the ease of access through things like Robinhood, the Bitcoiners that are getting tattoos and riding it all the way up. It's wild times, and you just got to be careful. And diversify. Talk to the professional, and if you want to be a professional, know that you should start small and work your way up.
Amen.
Patrick, awesome.
You've been very generous with your time, man. Thank you.
Generous with your time. Your energy and enthusiasm is amazing. Can't wait to have you back soon, and good luck in the trading world.
Thank you very much. All right, take
Enjoy
care, guys.
Barbados.
I will. All right, cheers. Thanks, guys.
Cheers.
Today's podcast is brought to you by Horizon's Resolve Adaptive Asset Allocation ETF, which trades on the Toronto Stock Exchange under the ticker symbol HRAA and is sub-advised by Resolve Asset Management. HRAA is an alternative fund whose investment objective is to seek long-term capital appreciation by investing, directly or indirectly, in major global asset classes, including, but not limited to, equity indices, fixed income indices, interest rates, commodities, and currencies. HRAA gains exposure to these asset classes by investing in derivative instruments that may include future contracts and forward agreements and securities. HRAA will take long or short positions, using up to a maximum of 3 times leverage in asset classes such as equity indices and fixed income asset classes, commodities, currencies, volatility indices, and other alternative asset classes. To learn more about this, please visit www.horizonsetfs.com/HRAA to read about the ETF's investment objectives and important disclaimers about the risks associated with an investment in the ETF.